do some vertical analysis using the income statement. And with the income statement, the number that gets set to 100% is your net sales for each year. And so that is your 100% number. If you had a problem where you had gross sales, less sales returns and allowances, less sales discounts, and then you got down to net sales, it would still be net sales that was 100%, and your gross sales would be maybe 103% or something like that. So net sales. Then we simply divide every other number by that number. So we go 465 divided by 750 gives us 62%. 285 divided by 750, 38%. And we would do 105 divided by 750, 14%. 60 divided by the 750, that's 8%. And so forth, each number divided by our net sales. And we would come down to various percentages, and we would be setting the entire income statement sort of in a common size, and so we could compare it to other years. Over here, our 600 is the 100% for 2014, so 390 divided by the 600, we get 65%. 210 would be 35%. And then we go 66 divided by the 600, 11%, 9%, 5%. 147 divided by 600, 25%, and net income 11%. So then we can look at this and make some comparisons. Okay, so our net income, 11% of net sales both years. Okay, that's kind of in line. Our income tax expense consistent from year to year. Our administrative expenses dropped slightly in terms of the percentage of net sales. However, our selling expenses increased as a percentage, so that might be something we'd want to take a little look at. The cost of goods sold decreased, so that was, that would be a good sign. Your cost of goods sold means that you're having a little bit higher gross profit. And so then you'd probably want to look at some of these a little bit. If you see that there's something that's a little out of line, you might want to say, gee, why did that drop? Are we getting, worse quality goods, or are we getting, quantity discounts, or, see, it gives management sort of a tool to analyze how they're doing in various categories. Okay, so that is your vertical analysis using the income statement.